Step 1 of the accounting flow is collating source documents. When an entity has gathered all the source documents pertaining to its financial transactions, it will proceed to Step 2, the preparation of journal entries to record these financial transactions, which is what we will be covering today. Journal entries specify which account need to increase, which account need to decrease, and by how much. Now, I will introduce you to the double entry system. But before I start, what is the accounting equation again? Where does an entity obtain its assets from? Internally and externally, right? Yes, assets equal liabilities plus equity. In the double entry system, you will hear the terms debit and credit. Debit and credit means plus and minus in the language of accounting. But it is different from what you expect. On the left side of the equation, that is the asset side, debit means plus. And on the right side of the equation, that is the liabilities and equity side, credit means plus. On the flip side, credit is a minus for assets, and debit is a minus for liabilities and equity. Now, I want you to reflect on something now. In the video on the accounting equation, I told you that equity comprises of capital and profit. So, which is a debit and which is a credit for the two? With that, let's expand the accounting equation. Equity can be further classified into capital plus income minus expenses. If you've played around with the expanded accounting equation, you will probably realize that assets plus expenses equal liabilities plus capital plus income. The left side of the rearranged accounting equation is known as the debit side, and the right side is known as the credit side. This means assets and expenses will have increases recorded in the debit side, while decreases recorded in the credit side. Liabilities, capital, and income will have increases recorded in the credit side and decreases recorded in the debit side. Now, what is debit or credit? In the general journal and ledger accounts, there will be two columns for you to record the monetary value of transactions, one called debit and one called credit. So a debit entry means you record the figures on the debit column, and a credit entry means you record the figures on the credit column. Please note the following. A transaction must affect at least two elements, and the accounting equation must balance after each transaction. In the double entry rule, it states that a transaction must have a debit entry and a credit entry, with the overall of both entries being equal. Let's go through some journal entries for routine transactions. First, owner contributed money into the business. What accounts are affected? Cash is clearly one of them. Then, what's the other? Is this an internal financing or an external financing? I hope you recognize this as an internal financing, as it is the owner who contributed money into the business. So capital is the second account that is affected. Both accounts have increased. Cash is an asset, and capital is one component of equity. Now, do we enter a debit or a credit entry? You may want to refer to this diagram here again to refresh your memory. An increase in asset is a debit entry. An increase in equity is a credit entry. So the journal entry to enter is debit cash and credit capital. I wrote here capital contribution to the business. This is called a narration. It briefly summarizes the transaction so that you have a brief idea what the transaction is. Next, now let's assume the business borrowed money from the bank. Again, cash will increase. Cash is an asset, and from the previous example, we noted that debit increases an asset. What is the other account that will change? This is a bank loan, and the bank is an external party, so it is a liability. The liabilities, specifically the bank loan account, will increase. Refer to the same diagram again. An increase in liabilities is a credit entry. Hence, this is the journal entry we are entering. Debit cash and credit bank loan. Third example, purchase inventory from supplier on accounts. Now, I want to introduce you to two terms here. First, inventory are goods meant for resale. Second, purchase on account means the supplier give you the goods first, but you don't pay now, you pay later. This is not common in our day-to-day life because we are consumers purchasing from businesses. Consumers usually buy things and pay upfront. However, for a business-to-business transaction, most sales and purchase are on account. The goods are transferred first, but payment will be made at a later date. The date of payment is determined according to the agreement between the two businesses. I believe it is quite clear that inventories will increase. Inventory is an asset because it will subsequently be sold, generating economic benefits. An increase in asset is a debit entry. The other account that will increase is called accounts payable. It represents the amount of money you owe your supplier for inventories purchased on account. What type of account do you think it is? Who supplied the inventory to the business? The inventory is provided by the supplier, an external party, so it is a liability. The business took inventories from the supplier but have not paid yet. He needs to pay the supplier one day to settle the amount owing. An increase in liability is a credit entry. Thus, the journal entry to record this transaction is to debit inventory and to credit accounts payable. Fast forward to the day the business pays the supplier for goods purchased. Paying the supplier money decreases the cash balance. When an asset decreases, we enter a credit entry. The accounts payable will also decrease, because after paying the supplier money, you owe lesser money, right? This is because you have settled the debt and fulfilled your responsibility to pay the supplier for the amount owing. From the previous example, we know that accounts payable is a liability. So referring to the diagram below, a decrease in the liability is a debit entry. So we will enter the following journal entry: debit accounts payable and credit cash. After the business have purchased inventories, it expects to sell them one day. Here, the business sold goods to customer on account for $184,000. The goods were purchased at $92,000. Now, I suppose you notice I assign a number for this transaction, because this transaction involves slightly more work and it may be a little bit confusing. When a business sells its inventory, it will have lesser inventory left. Inventory is an asset, and a decrease in asset is a credit. Since the business purchased the inventory at $92,000, the inventory account will decrease by $92,000. What is the other account affected? I hope you remember that when the business sold the goods to its customer on account, it gives the customer goods first, but the customer will pay at a later date. An account called accounts receivable will increase. Accounts receivable represents the business rights to collect money from its customer if the customer owes the business money for goods purchased on account. Since it will give the business an economic benefit by allowing them to collect money from its customer for amount owing, it is an asset. An increase in asset is a debit entry. The goods are sold at $184,000. So the accounts receivable will increase by $184,000 as it represents the amount of money the business can collect from the customer. Now we have a problem here. We have a debit entry and a credit entry, but the amounts are different. Did we make a mistake somewhere? Actually, no. More accounts are affected by this transaction. Think about it. Why did the account receivable increase? It is because the business sold something to the customer, and by doing so, profits will increase. Specifically, income will increase. We call this income sales, which is the income generated from selling goods to customers. Maybe now we should refer to this diagram or the expanded accounting equation instead. You will notice that income is a credit nature account, and increase in income is a credit entry. We will credit sales by $184,000 as this is the amount the business charged its customer. Now, did the total debit equal total credit? No, we are still missing something. What else? This time round, we have to account for the decrease in inventory. I hope you remember that an expense is incurred when you benefited from a service or used up an item. In this case, the inventory is used up. We will recognize an expense called cost of sales or cost of goods sold. When purchasing an inventory, we will initially recognize it as an asset. The inventory will be recognized as an expense only when it is consumed, in other words, sold. As this is an increase in expense, we will debit the cost of sales account by $92,000, the price at which the business purchased the goods at. Finally, the total debits equal total credits. So here comes the journal entry. Debit sales and credit accounts receivable by $184,000. This recognizes the sale of goods on account. We use $184,000 because that is the selling price charged to the customer. Next, we debit cost of sales and credit inventory by $92,000. This recognizes the cost of inventory sold. We use $92,000 because that is the cost price from the supplier.